Hello everyone. I am Elvijan Mangalao, and I am here to discuss two topics from Chapter 9, and these are the net investment or the NINV and the practice of cash flow estimation for capital budgeting. But first, let me give you a short introduction on what is capital budgeting. I know that my groupmate already discussed on what is capital budgeting, but to refresh your knowledge about it, I am going to give you a little discussion or little definition on what is capital budgeting. A capital budgeting is the process that a business undertakes to evaluate potential major projects or investments. Construction of a new plant or a big investment in an outside venture are examples of projects that would require capital budgeting before they are approved or rejected. Well, capital budgeting is also known as investment appraisal. Now we will proceed to the first topic that I am going to discuss in this video. First, what is a net investment or NINV? Or NINV, it is the total amount of funds that are spent by a company to purchase capital assets, less the associated depreciation of the assets. The net investment figure provides an accurate depiction of how much is spent on tangible assets such as property, plant, and equipment, and other capital assets. A net investment is also a good indication of how much is being invested in the productive capacity of a company, especially if it is a very capital intensive business. If gross capital expenditures are higher than depreciation, then the net investment will be positive, which indicates that the productive capacity of a company is increasing. However, if the opposite is true and depreciation is bigger than the gross capital expenditures, then the net investment will be negative, which indicates that the productive capacity of a company is actually decreasing. And it is the uh, sad part of a situation in a company when your investment is decreasing. It can potentially be a major issue. Uh, it can potentially be a major issue for a company since it shows that there is a limited growth potential. The net investment or the NINV in a project is defined as the project's initial net cash outlay. That is the outlay at time period. In this slide, we will tackle about the calculation of the net investment using the following steps. The step one here is the new project cost plus any installation and shipping cost associated with acquiring the asset and putting it into service, or in other words, it includes the total installed cost to get the project up and running, plus any increase in net working capital initially required as a result of the new investment, or it is the increase in net working capital which increases the net investment, minus the net proceeds from the sale of existing assets when the investment is a replacement decision. And It is also known as the proceeds from the sale of the existing assets, or it is the decrease in the NINV, plus or minus the taxes associated with the sale of the existing assets and or the purchase of the new assets. It includes the tax consequences from the sale of the existing assets. So it is equals to the net investment. The calculation of the net investment for two example projects is illustrated in later sections of the chapter dealing with asset expansion and asset replacement projects, which will be reported or will be discussed by my group mate. So I will not tackle it in this video. Also discussed are some of the tax consequences that can influence the net investment of a project. These tax effects are the treatment of gains and losses from asset sales in the case of replacement decisions. If a project generates additional initial investment in accounts receivable required, moreover, if additional inventories are necessary to generate the increased revenues, there is an additional initial investment in inventory is required too. This increase in initial working capital, that is cash, accounts receivable, and inventories, should be calculated net of any automatic increase in current liabilities, such as accounts payable or wages and taxes payable, that occur because of the project. As a general rule, replacement projects require a little or no net working capital increase. Expansion projects, on the other hand, normally require investment in additional net working capital. Some projects require outlays over more than 1 year before positive cash inflows are generated. It may take several years to design and construct a new production facility, such as an automobile assembly plant. So we have here an example. Uh, Consider a project requiring outlays of $100,000 in a year zero, $30,000 in year one, and $20,000 in year two, with a cost of capital equal to 10%. The NINV, or present value of the cash outlays, is calculated as follows. So we have here in year one, it was said that it requires $100,000, so cash outlay is $100,000, and we multiply it by 1, so the present value of cash outlay is $100,000. And then in year 2, we have year 1, we have $30,000, and we multiply it by 0.909, which will result to the present value of cash outlay into $27,270. And for the year 2, we have $20,000, which we multiplied into 800.826, which will result into 16,520. And if we add it all, it will result into $143,790, and that is our net investment. Okay. So why does net investment matter? So a net investment matter because it is necessary to invest in capital assets that depreciate over time. Companies may use the net investment formula to keep the assets that need to be replaced. As we are already finished with our first topic, which is the net investment, we will now proceed to our next topic, which is the practice of cash flow estimation for capital budgeting. So first, why is it that the practice of cash flow estimation for capital budgeting important? So we have here cash flow estimation is the foundation of capital budgeting for projects. So that is why the cash flow estimation is very important because it plays a major role in the business sector, especially in capital budgeting. And the next, it is the most important but also the most difficult step in capital budgeting. Oh, it is because uh, budgeting money is never easy. And when it comes to business, there are so many daghang mga pasikot-sikot and daghang mga uh, dapat nimong agian to para laman nimo makuan ang budgeting, ang capital, ang money na nadapit. So maybe it is very or so sa nakabutang nga diri, it is the most difficult step, but it is also the most important, right? So next, so we have here the annual net cash flow worksheet for the Briggs and Stratton drill press acquisition. So we have here change in revenues in year 1 to 10, then minus the change in operating cost from year 1 to 10, minus change in depreciation, and then equals change in operating earnings. And then before taxes to siya. Then here minus tax equals change in operating earnings after taxes. Then plus change depreciation minus change in net working capital equals net cash flow before salvage, and then plus salvage minus tax on salvage equals net cash flow. So the majority of the firms responding to the survey had annual capital budget of more than $100 million. Nearly 67% of the firm prepared formal cash flow estimates for over 60% of their annual capital outlays, and a majority produced detailed cash flow projections for capital investment requiring an initial outlay of $40,000 or more. And we have here the summary project cash flow for Briggs and Stratton in table 9.7. So we can see here in this table the summary of their project cash flow. So firms with high capital intensity and high leverage were more likely to have one or more persons, such as a financial analyst, treasurer, controller, or department manager designated to oversee the process of cash flow estimation. This reflects the larger number of projects associated with capital-intensive firms and the need to effectively manage the risk associated with high leverage. So, when asked about the types of cash flow estimates that were generated, it was said that 56% indicated that they used single dollar estimates. 8% used a range of estimates, and 36% used both single dollar estimates and a range of estimates. There was a significant positive correlation between firms that use both types of estimates and measures of operating and financial risk, suggesting that the use of a range of estimates is one procedure of managing high risk. So, forecasting methods employed by the respondent firms included subjective estimates from the management, sensitivity analysis, consensus analysis of expert opinions, and computer simulation. Many firms used multiple cash flow forecasting techniques. The longer the forecasting horizon, that is, the longer the economic life of the project, the more likely a firm is to use multiple methods for forecasting future cash flows. Financial factors considered to be important in generating cash flow estimates include working capital requirements, project risk, tax considerations, the project's impact on the firm's liquidity, the anticipated rate of inflation, and expected salvage value. Important marketing factors considered include sales forecast, the competitive advantages and disadvantages of the product, and product life. Important production factors include operating expenses, material and supply cost, overhead and expenses for manufacturing, capacity utilization, and startup cost. And then, three-fourths of the companies surveyed made comparisons between actual and projected cash flows, with nearly all the firms comparing actual versus projected initial outlays and operating cash flows over the project life. About two-thirds of these firms make comparisons of actual versus projected salvage values. The most accurate cash flow estimates are reported to be the initial outlay estimates, and the least accurate element of cash flow is the annual operating cash flows. Cash flow forecasts were more accurate for equipment replacement investments than the expansion and modernization investments or for acquisition of ongoing businesses. Firms with an information system in place to generate cash flow forecasts tend to produce more accurate forecasts than firms with less sophisticated capital project evaluation procedures. And that ends our discussion for this video. And I hope that you have learned something from what I have discussed earlier. And that's all, everyone. Thank you for watching this video. And um, stay safe, everyone, since COVID-19 is still here. And so, stay safe, stay at home, and good luck to us. Thank you again. God bless.